merger arbitrage, spin-offs, distressed debt. These are three strategies legendary investor Joel Greenblatt is famous for using. And while they sound complex, they can completely change the way you think about investing. By the end of this video, you'll know which of these special situation tools could realistically work for an individual investor and one simple step you can take to start applying the idea today. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about special situation investing strategies. Special situations often behave differently from the broader stock market. If you understand the event driving the price, you can sometimes uncover returns that don't depend on whether the market is up or down. So let's begin with the first of these strategies, the one that puzzles a lot of investors even at the announcement stage. Merger arbitrage, also known as risk arbitrage, is the practice of trying to capture the small gap that exists between a company's current stock price and the price a buyer has agreed to pay in a takeover. On paper, it looks straightforward. A larger company announces it's buying another for $50 a share, but the target stock might only trade at $48 or $40. That difference is where the strategy lives. Think of it like this. Imagine you promised to sell your car to a neighbor for $10,000 in 3 months. If someone wanted to buy it from you today, they wouldn't give you the full $10,000. They might pay $9,800 because there's still a chance the deal falls apart. The neighbor could change their mind or financing might not come through. In the stock market, that discount is called the spread. It's the difference between the offer price and the actual market price. And it exists because investors always factor in uncertainty. That spread is the potential profit if the deal closes as planned. Take Amazon's $42 per share offer for Whole Foods. When the deal was announced, Whole Foods stock traded closer to $40. Arbitrage traders quickly bought at that lower price, expecting Amazon to follow through, and when it did, the spread closed and those traders locked in a small but reliable gain. The catch is obvious. When deals collapse, losses can be fast and painful. Regulators blocked Kroger's attempt to acquire Albertsons, wiping out much of the spread investors had counted on. In another case, DuPont's buyout of Rogers Corporation unraveled after repeated delays, causing the target stock to plunge. These examples show the two main risks, regulatory approval and timing, that can turn a textbook spread into sudden losses. Unlike buying a company for long-term growth, merger arbitrage depends on one event you have little control over. Joel Greenblatt himself has been clear on this point. He warns individual investors that merger arbitrage often requires constant monitoring and quick action. If multiple deals fail around the same time, even experienced funds can face losses. That's why he suggests this strategy is usually better left to specialists or very active traders who can track dozens of moving parts at once. So how do professionals judge if a deal looks attractive? They start by running basic numbers. If a buyout offer is $50 and the stock trades at $47, the spread is $3. If the deal is expected to close in 6 months, that $3 gain can be annualized and compared to the returns of safer options like bonds. But the real challenge isn't the math, it's the judgment call. You need to ask, is there a strong chance regulators step in? Does the acquiring company actually have financing secured? Will shareholder approval be straightforward or contentious? Those questions can shrink or widen the spread from one day to the next. Here's a quick rule of thumb you can use if you ever look at a merger arb situation. Ask yourself 3 things. 1, how wide is the spread compared to the time you'll need to wait? 2, what's the expected timeline until close? And 3, are there obvious hurdles, like regulatory approval or shaky financing, that put the deal at risk? If the answer to the last one is yes, the spread often signals that extra danger. This is why many investors think of merger arbitrage as bond-like. The upside is usually modest and capped, and the payoff depends on one critical condition being met. The difference is that bonds expose you to credit risk over years, while merger arbitrage exposes you to deal risk over months. Steady gains may look attractive, but one broken deal can quickly offset several successful ones. The bottom line is simple. Merger arbitrage isn't about chasing big winners. It's about combining modest potential returns with careful discipline in screening deals. If you're not ready to track financing documents, regulatory calendars, or shareholder votes, it's probably one to watch from the sidelines rather than dive into directly. But not all special situations involve outside buyers. Sometimes a company creates opportunity all on its own by carving off part of itself into a brand new independent business. That's where the next strategy comes in. Why do so many investors rush to sell the stock of a newly spun off company, even when they received it for free? At first glance, it makes little sense. A spinoff occurs, Shareholders get new shares automatically, and then a large portion of them dump the stock almost immediately. That wave of selling is exactly what creates mispriced opportunities, something Joel Greenblatt called one of his most reliable setups in special situation investing. In plain English, here's how a spinoff works. A large parent company decides one of its divisions is better off as a standalone business. It separates that unit, sets it up with its own management and finances, and distributes shares of the new company directly to existing shareholders. Overnight, you own stock in two separate firms instead of one, and each trades independently. The mispricing often appears because many institutional investors don't actually want the new shares. The spinoff may be too small for their fund's minimum size, it might fall outside their industry mandate, or it may not yet be included in the benchmarks they track. The result? Those investors sell their shares regardless of the new company's prospects. That forced selling frequently drives the price lower than it should be, especially in the early months, exactly the point believed patient buyers could step in. A well-known example came when eBay spun off PayPal. As an independent business, PayPal quickly gained strategic freedom to pursue partnerships and scale beyond eBay's platform. The stock was undervalued at first, but investors who held onto or bought into the spinoff benefited as the company took advantage of its independence. Greenblatt's logic was simple but powerful. Because the selling pressure doesn't reflect the business's actual value, you sometimes get the chance to acquire a strong company at a discount. Beyond that, the leadership of a newly spun off unit is often liberated from competing for capital and attention under the parent. Like a young adult moving out of the family home, they can finally set priorities, take risks, and chart their own path. Academic research backs this up. Studies consistently find that spin-offs often show improved operating performance and deliver positive long-term abnormal returns once the dust settles. How do you know which spin-offs are worth taking seriously? One reliable checkpoint is to track insider activity. If executives or directors are buying shares right after the spin-off, it usually signals they believe the market price undervalues the company. Insiders know the business better than anyone else, and when they put their own money on the line, it's one of the most meaningful positive signs you can find. Of course, not every spin-off is an overlooked gem. Sometimes a parent company uses the process to clean house, loading the spin-off with debt or offloading the divisions it doesn't want. In those cases, shareholders aren't receiving an attractive standalone business, but a weaker unit designed to free the parent from baggage. That's why it's important to examine whether the spin-off starts life with a manageable balance sheet and a clear growth direction. A business that begins burdened with heavy debt is far less likely to deliver the kind of outperformance investors hope for. Here's the bottom line. Spin-offs often create mispricings and attractive opportunities, but they come with medium to high complexity and specific risks: execution risk, information asymmetry, and limited liquidity. Academic studies do show that viable spin-offs frequently outperform over time, yet evaluating them requires careful attention to management incentives, financial structure, and market conditions. If insiders are buying early, that's a meaningful positive sign. While spin-offs can reward disciplined investors who navigate that complexity, some of the biggest potential gains and dangers emerge in situations where companies aren't celebrating new independence, but fighting for survival. Sometimes the biggest opportunities appear when a company looks like it may not survive at all. This is the world of distressed debt investing, buying bonds or loans of struggling companies at steep discounts, hoping they recover enough to pay more than the market expects. In simple terms, companies raise money by issuing bonds. When they're financially healthy, those bonds might be worth 100 cents on the dollar. But if the business shows signs of default, the bond collapses in price, trading at 40 cents, 30 cents, or even lower. At that point, they're considered distressed because the market assumes bankruptcy is highly likely. For most investors, these bonds look like danger signs. For distressed specialists, they can represent an opportunity to buy assets for far less than face value. Here's the basic math that makes it attractive. Imagine you purchase a distressed bond for 40 cents on the dollar. If the company restructures and eventually repays in full, you'll be paid back $1. That's more than doubling your investment. The catch, of course, is that if the business doesn't survive or assets don't cover liabilities, you might lose most of your capital. Bankruptcy courts often decide who recovers what, and outcomes can vary widely. A simple real-world case illustrates both the risk and reward. During American Airlines bankruptcy in the early 2010s, its bonds traded at deep discounts. After restructuring and later merging with US Airways, those same bonds recovered sharply in value, rewarding investors who had correctly judged the recovery potential. It's important to see distressed debt as highly cyclical. Opportunities expand when market conditions tighten, such as periods of rising interest rates or when corporate leverage runs high. Historically, those conditions create larger pools of distressed borrowers, giving specialists more chances to buy debt cheaply. But timing is unpredictable. and downturns can punish anyone who jumps in unprepared. One reason distressed debt is so specialized is the need for deep legal and restructuring knowledge. It's not enough to study a balance sheet. You need to understand bankruptcy law, creditor hierarchies, and the fine details of reorganization plans. Bonds do sit above equity in the capital structure, meaning bondholders often receive something before stockholders, but the amount and timing depend heavily on negotiations and court rulings. That's why analysts emphasize this area is rarely suitable for casual investors. If you're curious about the space but not comfortable sifting through bankruptcy filings, a practical alternative is to use professional vehicles. Funds and ETFs managed by distressed specialists give you exposure to the strategy without requiring you to analyze creditor rights or restructuring terms yourself. For most individual investors, this is the safer way to participate. Still, even if you never buy a distressed bond, you can learn from the mindset. Ask 3 quick questions whenever you hear about a distressed situation. What's the realistic recovery value of the assets? Who ranks ahead in the capital structure and will get paid first? And is there a credible restructuring plan to turn the business around? Thinking this way helps frame the risk clearly rather than focusing only on potential upside. Here's the bottom line. Distressed debt carries some of the highest risk and highest potential reward of all special situation strategies. Unlike merger arbitrage, which hinges on deal closure, or spin-offs, which hinge on execution after separation, distressed debt demands confidence in a company's survival through bankruptcy. It can deliver extraordinary payoffs for professionals with diversified portfolios and legal expertise. But for most individuals, it's best approached indirectly through funds. Viewed side by side, these strategies may look completely different, yet they all raise the same central question. How much risk are you really taking, and how sure are you about protecting against losses? That question leads directly into Greenblatt's guiding principle, the philosophy that shaped how he approached every special situation. Joel Greenblatt put it simply, if you don't lose money, most of the remaining alternatives are good ones. That one sentence captures the center of his risk philosophy, the idea of margin of safety. Margin of safety means you only commit capital when you believe, even if events turn against you, the loss is small enough to survive. It's not about predicting winners with perfect accuracy. It's about fencing off scenarios that could wipe out years of progress. Most investors obsess over the potential return, but Greenblatt started with a tougher question. If I'm wrong, how much can I lose? An analogy helps here. Imagine a bridge with a 10-ton weight limit. Driving a 9-ton truck across might work, but there's no cushion if something unexpected happens. A 5-ton truck, on the other hand, passes with room to spare. Margin of safety is choosing the lighter truck. In finance, that means you leave yourself a cushion so unexpected stress doesn't collapse the structure. Without it, even a small shock can crack your investment thesis. Take merger arbitrage. On paper, it looks clean. The offer price is published, the current stock price is lower, and the spread represents your profit if the deal closes. But what if regulators intervene or approvals drag on? That's what happened when DuPont's attempted acquisition of Rogers was delayed by antitrust reviews until it collapsed. A guaranteed spread flipped negative. Here, the true margin of safety lies not in the precision of the math, but in the judgment about whether the deal has enough room to survive obstacles like regulators, financing risk, or shareholder votes. Spin-offs show the same principle in another form. At first, a spun-off stock is often pushed lower by automatic selling. The margin of safety isn't in assuming the business thrives instantly, but in recognizing that short-term selling may create a price well below reasonable value. If you're buying at a steep discount, you have a cushion. Even if management stumbles, you're less exposed to permanent capital loss. Then there's distressed debt, the most extreme example. You're considering bonds of a company in bankruptcy or near it. These bonds can trade at 30 or 40 cents on the dollar. The only way you have a margin of safety is if even a partial recovery, say 50 cents, gives you a gain. Without that level of discount, the downside of complete failure overshadows the potential reward. The mindset applies across all these situations. The strategy may differ, but the anchor is the same. Avoid permanent loss, not chase maximum upside. Protect the downside, and the upside tends to follow naturally. For you as an individual investor, putting this into practice means slowing down and asking blunt questions before you commit capital. You can turn margin of safety into a short checklist. 1. What's my worst case loss if the event fails? 2. Is the current market price far enough below fair value to give me a cushion? 3. Can I realistically afford the time and monitoring this situation demands? Saying these out loud forces you to test your conviction. Another way to think about it, instead of asking, how much can I make? Ask, how much can I live with losing and under what conditions? That shift in perspective puts you in line with Greenblatt's practice of playing defense first. It's not a pessimistic lens, it's a durable one. By shaping decisions so you can stand even if things break, You leave space for compounding to work over time. This philosophy is also what ties Greenblatt's different playbooks together. Merger arbitrage spreads, spin-off mispricings, distressed bonds, each has its mechanics, but the unifying principle is risk first, return second. When you build decisions around that idea, you filter out fragile bets and focus only on those you can afford to hold through turbulence. So the real takeaway isn't just to understand these strategies, it's to filter them through the same lens Greenblatt used. Where is my protection if things go wrong? Once you've internalized that, the next step is deciding which of these situations realistically fits your own toolkit, given your time, risk tolerance, and resources. So let's turn to the practical side. Which of Greenblatt's special situation strategies could realistically fit into your approach? Each one places very different demands on your time, focus, and tolerance for uncertainty. So matching the right tool to your temperament is key. Start with merger arbitrage. At first glance, it looks simple. Buy the shares of a takeover target below the announced purchase price and wait to collect the difference when the deal closes. But the execution is anything but casual. Deals can stall if regulators get involved, financing can disappear, and shareholder approvals can derail the process. For an individual investor willing to try this, one strict rule helps keep it manageable. Never commit more than a small fraction of your special situations allocation to any single deal, and set a clear monitoring rhythm, daily or weekly, to review filings and deal updates. That routine forces discipline and helps you step out quickly if conditions shift. If your style leans toward passive or set it and forget it, this path asks more vigilance than most are willing to give. Spin-offs often line up better with individuals looking for long-term opportunities. The dynamic is closer to bargain hunting. When a parent company splits off a division, many institutions sell the new shares immediately just because they don't fit portfolio rules. That automatic selling can push a stock down in its early months, giving patient investors a chance to buy at lower than fair prices. To make this actionable, here's a simple exercise you can start right now. Build a watch list of 3 announced spin-offs, track how their prices move during the first 3 to 6 months, and keep notes on whether insiders are buying shares themselves. Treat it purely as a learning experiment. You'll get practice spotting the mismatch between early selling and long-term value without risking capital until you understand the pattern. This patience-driven strategy demands less speed and more willingness to sit still while the market eventually reprices the business. Distressed debt sits on the far end of complexity. The basic idea of buying a bankrupt company's bonds at a discount, say 40 cents on the dollar, seems tempting. But in reality, it requires expertise in bankruptcy law, creditor negotiations, and restructuring details. One wrong assumption can erase gains quickly. For individual investors, the safer path isn't trying to buy distressed bonds directly. It's accessing them through vehicles designed for this purpose. Specialist distressed debt funds and ETFs are built by professionals who can navigate the legal and financial landscape. If you want exposure, use those instruments rather than trying to manage a recovery process on your own. More importantly, even if you choose not to invest, the mindset of distressed investing, looking where fear has created oversold assets, can be applied to healthy markets when pessimism temporarily crushes valuations. At this point, it helps to tighten the comparison. Think of it this way. If you're an active, deal-focused trader who doesn't mind constant monitoring, merger arbitrage is your lane. If you're more patient and research-oriented and like spotting businesses overlooked by big funds, spin-offs are built for you. And if you're curious about how investors profit from crisis but want safer access, distressed exposure through specialist funds is the right balance. 3 approaches, 3 investor profiles. To put all this into practice, don't rush into positions. Instead, start small with observation. Track a few spin-offs, study merger spreads, and follow updates from distressed debt funds. These steps sharpen your eye for patterns while keeping risk contained. Once you've built confidence in how each situation unfolds, you'll be better positioned to decide which, if any, deserves a place in your portfolio. As you weigh these paths, remember the principle that ties them all together. None of these strategies are shortcuts. They only work when paired with discipline and careful respect for risk. That's the lens you should keep front and center as we bring everything together in the final takeaway. Here's the simplest takeaway you can act on right now. Start a watch list of 3 upcoming spin-offs, track their prices for the first 3 to 6 months, and note whether insiders are buying. Treat it as a learning experiment, not a buy signal. That exercise anchors you in Greenblatt's margin of safety mindset. Observe first, then decide if the downside risk looks truly limited. And one quick note, with higher interest rates and stretched corporate debt, distressed opportunities are likely to surface more often. If you found this useful, subscribe for more and tell us in the comments, which of the 3 strategies would you try first and why?